What if I told you that one of the biggest financial disasters in history started with something as ordinary as a home loan? It wasn't a war.
It wasn't a natural disaster.
It wasn't a pandemic. Yet it wiped out trillions of dollars, caused businesses to collapse, banks to fail, and millions of people around the world to lose their jobs, homes, and life savings. But here's the most shocking part. The people who were supposed to prevent this crisis, the banks, actually played a major role in creating it.
So, how did giving people home loans turn into a global financial disaster?
Why did some of the world's biggest banks suddenly collapse? And how did a crisis that started in the United States affect families in countries thousands of miles away? In this video, we'll break down the 2008 financial crisis in the simplest way possible using easy examples and simple animations. By the end of this video, you'll understand exactly what happened, why it happened, and the important lessons the world learned from it. So without wasting any time, let's go back to the early 2000s, where this incredible story begins.
Chapter 1: What was the 2008 financial crisis?
Before we understand how the crisis happened, let's answer the most basic question. What exactly was the 2008 financial crisis? Imagine you wake up one morning and hear that one of the biggest banks in your country has gone bankrupt. People rush to withdraw their money. Companies stop hiring. Businesses start closing. Stock markets crash. Millions of people lose their jobs. This isn't the story of a movie. This is exactly what happened in 2008. The 2008 financial crisis was one of the biggest economic disasters since the Great Depression of the 1930s.
It began in the United States, but because countries and banks around the world were connected, the crisis quickly spread across the globe.
Families lost their homes because they couldn't repay their home loans.
Businesses couldn't get loans to keep operating.
Investors lost billions of dollars.
And governments had to spend huge amounts of money trying to stop the entire financial system from collapsing.
But here's the interesting part.
This crisis didn't begin because there weren't enough houses.
It didn't happen because people suddenly stopped working.
And it wasn't caused by a natural disaster.
Instead, it started because of a dangerous combination of greed, risky decisions, and the belief that house prices would keep rising forever.
To understand how this happened, let's imagine a simple town.
In this town, almost everyone wants to buy a house.
Banks are happy to lend money because they believe house prices will always go up. People think buying a house is the easiest way to become rich. Everything looks perfect, but hidden beneath the surface, a huge problem is slowly growing. And when that problem finally explodes, it doesn't just affect one family or one bank, it shakes the entire world.
So the next question is,
why did so many people suddenly start buying houses in the first place? Let's go back to the early 2000s and discover how the American dream became the beginning of one of the biggest financial crises in history.
Chapter 2: The American Dream: Why Everyone Wanted to Buy a House. To understand the 2008 financial crisis, we first need to understand something called the American Dream.
For many people in the United States, owning a home was more than just buying a house.
it was a symbol of success.
People believed that if you had your own house, a stable job, and a happy family, you had achieved the American dream.
Around the early 2000s, the US economy was growing and interest rates were relatively low.
This meant borrowing money became cheaper.
Banks started offering home loans to more and more people.
Suddenly, buying a house seemed easier than ever before.
Let's understand this with a simple example.
Imagine you want to buy a house worth $300,000.
You don't have that much money.
So you go to a bank.
The bank says,
"Don't worry, we'll lend you the money. Just pay us a small amount every month."
that sounds like a great deal. Now imagine millions of people hearing the same offer. More and more families started buying homes. As demand increased, house prices also began rising. People noticed something interesting. A house they bought for
$300,000 was worth $350,000 just a year later.
Then it became $400,000. Many people started believing that house prices would always go up. Some even bought second or third houses not to live in them, but to sell them later for a profit. Investors joined in. Builders built more houses. Banks approved more loans. Everyone seemed happy. People thought they were getting richer every year. But there was one big problem. Many buyers couldn't really afford these expensive houses. They were depending completely on loans.
And banks were becoming less careful about who they were lending money to.
At first, this didn't seem like a problem because house prices kept rising. But underneath the surface, the financial system was becoming weaker and weaker. It was like building a tall tower on a weak foundation.
Everything looked stable.
Until one day it wasn't. In the next chapter, we'll discover how banks started giving risky loans to people who couldn't afford them and how that decision pushed the world toward a financial disaster. Chapter 3: How banks started giving risky home loans. By now, house prices were rising quickly. People were excited. Banks were making money. Builders were building more homes. It looked like everyone was winning. But behind the scenes, banks made one of the biggest mistakes in financial history. Normally, when you apply for a home loan, the bank checks everything. They look at your income.
They check your job.
They see if you have borrowed money before and whether you paid it back on time. Only if the bank believes you can repay the loan do they approve it. This helps protect both the customer and the bank.
But during the housing boom, many banks became too confident. They believed house prices would continue rising forever. So instead of being careful, they started approving loans for people with low incomes, unstable jobs, or poor credit histories. These risky loans became known as subprime mortgages. Let's understand this with a simple example. Imagine Sarah earns $2,500 a month. After paying for food, transportation, and other daily expenses, she can realistically afford a monthly house payment of about $800. But the bank still approves a loan that requires her to pay $1,400 every month. Why would the bank do that?
Because it believed that if Sarah couldn't make the payments, the bank could simply take back the house
And sell it for an even higher price. After all, house prices had been going up every year, so the banks thought there was almost no risk. But that assumption was dangerous. Many families accepted loans they couldn't truly afford because they believed their incomes would increase or that they could refinance their loans later. For a while, everything seemed fine.
People kept buying houses.
Banks kept approving more loans. House prices kept climbing.
but the entire system depended on one important condition.
House prices had to keep rising. If prices stopped increasing or worse started falling, the whole system would be in trouble. And that's exactly what happened. The housing market slowed down. House prices stopped rising. Then they began to fall. Suddenly, millions of homeowners were trapped. The financial system was about to face one of the biggest shocks in modern history. In the next chapter, we'll see how the housing bubble burst and how one problem quickly turned into a global financial crisis. Chapter 4: The housing bubble burst. Everything started falling apart. For years, people believed one thing: house prices would never go down. Every year, houses became more expensive. A home bought for $250,000 could be worth $300,000 a year later. People thought, why not buy another house? I'll sell it later for a profit.
Banks thought the same way.
Investors thought the same way.
Almost everyone believed the boom would last forever. But this was actually a housing bubble.
A bubble forms when the price of something keeps rising not because it's becoming more valuable, but because everyone believes they can sell it for an even higher price.
Imagine a balloon. The more air you fill it with, the bigger it becomes. At first, everything looks fine.
But if you keep filling it with air, eventually,
The balloon bursts.
That's exactly what happened to the housing market.
Around 2006 and 2007, house prices stopped rising.
then they slowly started to fall.
At first, people thought it was just temporary, but prices kept falling.
Now imagine you bought a house for $300,000 using a bank loan.
A year later, the value of your house falls to $220,000.
You still owe the bank close to $300,000,
But your house is worth much less. Many homeowners felt trapped.
At the same time, some loans had low introductory payments that later became much more expensive.
When those payments increased, many families could no longer afford them. They missed one payment,
then another.
and soon thousands of people stopped paying their home loans altogether.
Banks began taking back these houses. This process is called foreclosure.
But there was another problem.
Since thousands of homes were now being sold at the same time, there were more houses than buyers. This pushed house prices down even further.
The more prices fell, the more people stopped paying their loans. And the more loans went unpaid, the more money the banks lost.
It became a dangerous cycle that kept getting worse.
What started as a problem in the housing market was now turning into a problem for the entire banking system. But the biggest shock was still to come. The crisis was no longer just about homeowners.
It was about to spread to banks, businesses, investors, and eventually the entire world.
Let's see how that happened in the next chapter. Chapter 5: How the crisis spread across the entire world. At this point, thousands of homeowners had stopped paying their loans. Banks were taking back houses. House prices were falling. You might be thinking, if this happened in America, how did it affect the whole world? The answer is simple. The world's banks were connected. Many banks didn't keep all of the home loans they gave out. Instead, they bundled thousands of loans together and sold them as investments to other banks, insurance companies, pension funds, and investors around the world. These investments looked safe because they were backed by thousands of home loans. People believe homeowners will keep paying their loans, so this investment is safe. But when millions of people stopped paying their mortgages, those investments suddenly lost a huge amount of their value.
Banks that had invested billions of dollars started suffering massive losses.
Soon banks stopped trusting each other. They became afraid to lend money because no one knew which bank might be hiding huge losses. Imagine your friend asks to borrow $100.
Normally, you would lend it without worrying, but if you hear that your friend has lost all of their money, you might refuse.
The same thing happened between banks.
Without trust, banks stopped lending.
And when banks stopped lending, businesses couldn't get loans to pay employees or expand their operations.
Some companies reduced production.
Others laid off workers.
Some even closed down completely. Stock markets around the world also fell sharply as investors became frightened. One of the biggest moments of the crisis came in September 2008, when the investment bank Lehman Brothers filed for bankruptcy. Its collapse shocked financial markets and showed just how serious the crisis had become.
Panic spread quickly.
Governments and central banks stepped in with emergency measures to stabilize the financial system and prevent even more banks from failing.
What had started as a problem with home loans in the United States had now become a global financial crisis.
Millions of people around the world lost their jobs. Businesses struggled.
Families faced financial hardship.
The crisis affected countries far beyond the United States because modern economies are deeply connected.
But after one of the biggest financial disasters in history, an important question remained. What lessons did the world learn, and how did this crisis change banking forever?
Chapter 6: What we learned from the 2008 financial crisis.
By 2009, the worst of the financial crisis had shaken the entire world.
Millions of people had lost their jobs.
Many families had lost their homes.
Some of the world's biggest banks had either collapsed or survived only because governments stepped in to help them. The crisis showed one very important lesson.
A strong economy is built on trust.
And responsible decisions. When banks became too greedy and gave loans to people who couldn't afford them, they took huge risks.
When investors believed that house prices would rise forever,
They ignored the warning signs.
and when everyone thought nothing can go wrong, that's exactly when everything went wrong.
After the crisis, governments around the world introduced stricter rules for banks.
Banks were required to keep more money in reserve.
They also had to be much more careful before approving home loans.
The goal was simple: to make sure a crisis like this would be much less likely to happen again.
The 2008 financial crisis also taught ordinary people some valuable lessons.
First, never borrow more money than you can comfortably repay. Just because a bank approves a loan doesn't always mean it's the right financial decision.
Second, don't assume that the price of an investment, whether it's a house, stocks, or anything else, will keep rising forever. Every investment has risks. And finally, remember that the world's economies are connected.
A financial problem in one country can quickly spread across the globe, affecting businesses, jobs, and families everywhere.
Even today, economists, governments, and banks continue studying the 2008 financial crisis because it changed the way the world thinks about money, banking, and financial risk.
It wasn't just a crisis about houses. It was a lesson about greed, trust, responsibility, and the importance of making smart financial decisions.
So, what can we take away from this incredible story?
Let's quickly recap everything we've learned and understand why the 2008 financial crisis is still remembered as one of the most important events in modern economic history. Let's explore that in the next and final chapter.
Chapter 7, Conclusion, the crisis that changed the world.
So, let's quickly recap everything we've learned.
The 2008 financial crisis didn't begin with a war or a natural disaster.
It started with something that seemed completely normal.
Home loans.
At first, buying a house looked like a great investment. House prices kept rising, banks kept giving loans, and people believed the good times would never end. But many of those loans were given to people who couldn't really afford them. Banks believed there was almost no risk because they thought house prices would keep increasing forever.
Then everything changed.
House prices stopped rising. People couldn't repay their loans. Banks started losing billions of dollars. One of the world's biggest investment banks, Lehman Brothers, collapsed. Panic spread across financial markets, businesses struggled, stock markets crashed, and millions of people around the world lost their jobs and homes. What started as a housing problem in the United States quickly became a global financial crisis because today's economies are deeply connected. But the crisis also taught the world some important lessons.
Never assume that prices will rise forever.
Never take on more debt than you can afford.
And always remember that trust is the foundation of every financial system.
Today, banks are more carefully regulated, governments monitor financial risks more closely, and people are much more aware of the dangers of borrowing and investing without understanding the risks.
Even after more than a decade,
The 2008 financial crisis remains one of the most important
events in modern history
because it changed the way the world thinks about money, banking,
and the global economy.
And that's why understanding this crisis isn't just about learning history. It's about making smarter financial decisions in the future.
Final outro and screen.
Before you leave, here's something to think about.
Do you think another financial crisis like 2008 could happen again? Or has the world learned enough to prevent it? Let me know your thoughts in the comments below. I read as many of your comments as I can, and I'd love to hear your opinion.
If you found this video helpful and learned something new, don't forget to like,
Share and subscribe.
And if you enjoy simple animated videos that explain money, business, economics, investing, history, and how the world works, make sure to turn on the notification bell so you never miss a new upload.
Thank you so much for watching and supporting the channel. See you in the next video.